Hello and welcome. Today's FinPod piece will explain basic finance terminologies targeting beginners as well as finance learners. This segment will cover 5 terms. Please comment or email us for more information about each term which is discussed today or any new term which you wish to know. Starting with annual report, what is an annual report? It is basically a company's report card. An organization's annual report provides a comprehensive overview of its internal functioning, especially its financial status. These report usually contains financial statements such as the balance sheet, income statement, cash flow statement, details about the company's business operations, significant projects, auditor's report, notes to account, many exciting graphics, future strategies, etc. The primary aim of the annual report is to give stakeholders. Now, who are the stakeholders for the company? They are the shareholders, investors, and employees who will get a clear and brief overview of the company's performance and activities via annual report. A lot of investment decisions come after reading this report. Since annual reports for every company are available online, here is the data I learnt about Indian conglomerate ITC, the spread of its businesses. ITC is into FMCG, agri, paperboards and packaging, ITC hotels, and ITC Infotech. Its brands, recent launches, digital transformation adoption, sustainability efforts, etc. These reports are usually lengthy, but they are the best way to know the company's financial position. In the comment section, we are sharing the link for ITC's annual report for the financial year 23. Please comment yes if you are clear up to this point. Moving to the second word of the day, bonds. Bonds are one of the financial instruments. It is a fixed income investment instrument that symbolizes a loan from an investor to a borrower. In essence, they serve as a contract between the two parties. Typically, bonds are issued by corporations, governments, companies, and municipalities to finance projects and operations, undertake welfare activities, incur sudden war expenses, buy property, buy equipment, etc. The bonds come with a maturity date and a face value when the issuer returns your money, principal amount, and interest. Bonds are less risky compared to market-linked instruments like equities. Let me cite an example here to understand bonds further. Suppose a corporation wants to build a new manufacturing unit for 10 lakhs and decides to issue a bond offering to help pay for the plant setup. The corporation might decide to sell 1000 bonds to investors for rupees 1000 each, making each bond's face value rupees 1000. Let us bring our attention to the third term of the day, which is compounding. Basically, compounding means accumulation of wealth over time. Who does not like adding wealth? But it's critical to know how and when you do it. In simple terms, compounding refers to generating returns on an investment by reinvesting those returns. This growth in investment helps to increase wealth and achieve financial goals steadily. Case in point, if you invest rupees 1000 and earn a rupees 100 return in the first year, the following year your principal amount will be rupees 1100 and you will receive returns on this amount, leading to exponential growth in the long term. This is why it is crucial to start investing early. When you invest, compounding is possible, but it's not possible when you save. I hope you all are clear till this point. Coming to the next term, which is diversification, it is basically a risk mitigation technique. There is a saying in finance that says, do not put all your eggs in one basket. Having eggs in multiple baskets mitigates risk. Not all eggs are lost if one basket breaks. The only exception is the Easter festival, which is today. May the Easter bunny bring you joy and happiness this year. Anyway, navigating back to finance, diversification is a risk management technique that mitigates risk by allocating investments across different financial instruments, industries, and other categories. The idea behind this approach is that a portfolio constructed of various assets will, on average, deliver loftier long-term returns and lower the risk of any individual holding or security. However, no matter how diversified your portfolio is, eliminating risk is never possible. Let's say you own rupees 5000 worth of Tata Motors and that's your only investment. In the last month, Tata Motors' stock fell 20%, which would reduce your initial investment of rupees 5000 to rupees 4000, calling for rupees 1000 loss. Instead, if you owned equal amounts of Tata Motors, SBI, Colgate India, and Indian Hotels, which have 1 month returns of minus 20%, minus 12%, plus 1%, and plus 0.2% respectively, your initial rupees 5000 investment would still be worth rupees 4600, calling for only rupees 400 loss. This is diversification. The goal is to avoid overexposure to any single stock or sector. Here is the final word of the day: inflation, an economy barometer. Inflation is the general increase in the prices of goods and services in the economy, which decreases the purchasing power of money. From the consumer's point of view, inflation is often perceived about prices. Here is a simple example of inflation. In the year 2000, a moviegoer was able to buy a movie ticket for about rupees 200. Fast forward to today, when the average movie ticket cost is around rupees 400. In the year 2000, a person with rupees 400 could buy 2 tickets, but today that same rupees 400 could only buy 1 ticket. The currency has less value than it did before due to inflation. It is a common observation that older generations often remark on the lower cost of basics such as milk and bread in the past, attributing this to the impact of inflation over time. That is all from my side. Please comment yes if you found this easy to comprehend. Thank you for tuning into FinPod.